Okay, in this next example, we have a new project that's going to allow us to sell a brand new product at $50 a piece. Variable cost for this product is going to be $30 each. Fixed cost would run $50,000 per year. We're going to do two parts here. In the first part, let's say there's no initial investment required. How many units do we have to sell annually to break even? That's the accounting break-even quantity. If instead the firm, and then part two says if instead the firm has a necessary investment of $80,000 in fixed asset machinery, that it's going to depreciate straight line to zero over 4 years, what's the accounting break even in terms of units? Okay, so we'll just do this twice basically. Start with part one, which says no initial investment. So we have accounting units to break even, and that is fixed cost plus depreciation divided by the contribution margin per unit. But again, we don't have any depreciation, so it's just our fixed cost of $50,000 plus zero depreciation. Our contribution margin per unit is the sales price per unit minus the variable cost per unit. So 50,000 divided by $50 sales price minus $30 variable cost. This reduces to simply fixed cost divided by the contribution margin per unit, which is $20. And we see that we'd have to sell 2,500 units to break even on an accounting basis. So pretty straightforward, and break-even calculation is pretty straightforward. Remember, the hard part is estimating prices and variable cost and fixed cost. It's not in calculating the break-even ratio. So now what if we have a little more realism in the problem? Let's say we have an investment of $80,000 in machinery. We've got to depreciate that investment. We're going to do it straight line to zero depreciation. And so that means we're going to have our investment cost, right, or cost basis, divided by the number of years. Right. Now remember that straight line to zero is a special case of straight line depreciation, where straight line would also have, right, the cost minus the expected salvage value divided by the number of years. But straight line to zero is a special case where the IRS lets us set the expected salvage value equal to zero. And so we just depreciate the asset completely or fully all the way to zero over the life of the asset. So our cost basis is $80,000. We have no salvage value divided by 4 years of life, and we have $20,000 of depreciation expense per year. So now we can come back and recalculate our accounting units to break even. Because we do have depreciation in this case, we have $50,000 worth of fixed cost plus $20,000 worth of depreciation expense, and we have contribution margin per unit, that is the unit sales price minus the variable costs. And now we see that we'd have to sell 3,500 units rather to break even on an accounting basis.